Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hi there, welcome to the COB. I'm Nadine Blaney. It's great to be here with you on the 2nd of June, and I can see a little bit of sunshine outside the studios here in Sydney on what has been a pretty chilly day. We're watching a little bit of more warmth climbing into this local market as we head toward the close. Let's take a look at the CIBO Australia Index, now down just about 0.1%. Look, I've got to say the S&P ASX 200 is pretty much flatlining it at this stage. Last of the day's trade still rolling through, so it could have been a lot worse, and that is my optimistic view of the market for the day. Of course, it's all about Anthropic, isn't it? That's lots of the chatter, at least today, with the view that we're going to see this mega IPO beating OpenAI to market, also in the midst of a SpaceX IPO as well. So plenty of enthusiasm, but I wonder what that does to liquidity in the market. Today here we heard about a wages boost putting forth by the Fair Work Commission. What will that do for inflation? Well, it certainly does make the RBA's job a little bit more difficult. Of course, we're looking at this through a market's perspective, not paying any attention right now to what a difference that might make for many of the workers who are, like you and I, dealing with the rising cost of living. And in terms of corporate news, Northern Star, well, at least one hedge fund manager, one activist shareholder wants to see a bit of a shake up there. All right, our top corporate stories today. We've got Elliott Management confirming it's amassed a position of well over $1 billion in Northern Star and trying to put its requests on the table. Shares up by close to 14% to $21.08. Wesfarmers saying it will transfer its Blackwoods and workwear businesses into Bunnings from the 1st of July. Atlas Arteria urging shareholders to reject IFM Investors' takeover offer once a bit again, saying the bid materially undervalues the toll road operator. SRG Global has gained on $1.33 billion in contracts, leading it to upgrade its earnings guidance, and the share price is doing really well, up by 16%. Meanwhile, Kelsian has secured a 2-year extension to one of its Sydney, bus contracts. Just choked there. Happy for good old Kelsian, but didn't do much for its share price there today, at least. So that's just sort of scraping, I guess not going too deep into the corporate stories today, but a lot of the focus, you've got to think, still does remain on the macro, the geopolitics of it all, and of course, inflation. To talk to us about what he's watching, Martin Crabb, CIO from Shaw & Partners, is joining me in studio today. Excuse me.
Yeah, you choked on a bus.
I did. I choked on a bus. It's exactly what happened. All right, Martin. So, look, there's a lot of chatter out there, a lot of headlines being written. Have we seen the bottom of the tech route here in Australia?
Yeah, well, I think if you look at the ETF that follows the software names in the US, it popped 8% last night, and the only Aussie stock that's the IGV, so that's the US extended software ETF, and you can see that it's been on a pretty rocky old road since ChatGPT was launched all the way back in Nov 22. It was up and to the right, and then we've had these kind of concerns about AI eating all the software, and most recently that bottomed out in about April. But since April, but the bottom feeders have been in that sector in a big way in the US, and it's started to happen here. So even in the last 3 or 4 days, we've seen big moves up. You mentioned Life 360. It is actually in that index. It's the only ASX listed stock that's in that index. So it's not a massively traded stock, both in the US or here. So it doesn't take much movement in volume to get that thing going. So I think 360 was up close to 13% on the close. So it's been very beaten up. But there's a lot of those stocks. We had the management team from Xero in our offices today having a chat about, the macro is, that AI is going to eat software. But as they said, look, we're working with Claude, we're working with other models. They're actually making our software more valuable. They're making our network more valuable. They're making our connections and our client relationships more valuable. This is actually a good thing. Market's actually starting to come around to that view. So that big pop that we saw in that IGV is a global phenomenon, obviously, and it's caught fire in Australia. So the platform stocks, REA, car sales, Seek are all up today, as was WiseTech and other stocks in that tech sector.
So you say they have been bottom feeding. Does that mean not you?
Yeah, we've probably been long and wrong in some of those software names. We sort of bought into WiseTech and Life 360 at higher valuations, and you know, in hindsight, probably got in a bit too early. And now we're seeing those things bounce, and it's kind of a welcome. We didn't really sell down as the stocks are falling. I haven't really been buying in as they've been rising. We've just been holding our positions because our fundamental views haven't changed. It's just how the market's pricing these things. So market gets carried away in both directions. We've seen that in gold. Like there's these investors called tourists. Like they come and go. They go into gold when it's working, then they get out of it when it's not working. We try not to be one of those as investors. We try to look through the pricing and not get caught up in the euphoria or the fear of the market. So we've been holding fire on those names.
Okay, so that's the SaaS apocalypse. Perhaps we've been through the worst of it.
Yeah.
When it comes to the other key point, inflation, and I know it was a bit crude to link, you know, a lift in minimum wage to the RBA, but I mean, that's the reality, right?
It's a real issue, Nadine. So minimum wages, you know, according to the Fair Work Commission, go up 6%, and award wages go up 4.75. I think it's something like a third of the workforce is either at minimum or award wages. So this is a material impost for businesses. Now, if you're getting productivity, that's fine. Like, you know, if I can go to my boss and you can go to your boss every year and say, look, I'm 10% more productive, I want some of that, if not all of that, as a wage rise, then, you know, that's an arguable case. The problem is that productivity measured by GDP per hour's work is actually going backwards in Australia. So theoretically, employees are getting less out of each worker and they have to pay them more. It's like that maths doesn't add up. That's got to come from somewhere. Either it's higher prices to your customers or you've got to eat it in your margin. Now, some businesses have got a little bit of a fat margin, they can do it, but a lot of businesses are really struggling to make money. Like bankruptcies are running at a record level. It's bloody tough out there trying to run a business. So when you've got zero to negative labour productivity and, you know, 4 to 5 to 6% wage rises, that's got to put a lot of pressure on businesses. So the logical thing to do is just increase your prices, which adds pressure to inflation, and you know, and that's not what the RBA want to see. The flip side is that the Fair Work Commission's coming out saying it's really tough out there. You've got inflation. You need to give these people more money because they're really, really struggling to put food on the table. So there's this sort of circular argument. If you take that side, you know, people who are struggling, we need to give them a hand. That's the whole Australian ethos. Help people out that are weaker than you. But on the other hand, it's going to cause a problem if we need to put up interest rates.
Yeah, right? But it's a vicious cycle, isn't it? It's like, you know, I was going to use a different term, but I'll leave that one there. So are rates here going to increase? Because the other side of that equation is that if businesses do fold, that lifts the unemployment rate. That is one metric that the RBA is keeping a very close eye on. Yeah,
it's one of these really tricky things where, you know, there's a lot of capex going on. There's 150 billion of capex just on AI alone in Australia. It's more like $1 trillion globally, and it hasn't shown up in the productivity numbers. If I go back, you know, I'm old enough to remember the tech boom. And when PCs landed on everyone's desk, it's like, oh, we're spending all this money on these PCs. Some people didn't even know how to turn them on, right? So it took a while for those productivity benefits to come through, but they came through in spades. Like the white collar workers became incredibly more productive with a PC than before it. I think the same thing will happen with agentic AI. It's just going to take a while to catch on. So if you're the RBA, you're out there going, there's a massive labour productivity gain coming through that's going to be very deflationary. Do we wait and to see if that's going to happen, or do we just go, right, inflation's out of control, wages are going up too fast, we've got Straits of Hormuz staying closed forever, let's just whack up rates and knock this economy on the head? I think the market's shifting away from that narrative, and now it's got less than one rate hike priced in. So most economists are saying probably one in October, including George Theranou, who's the guy we most closely follow at UBS. He's saying one rate hike in August, then they're done. The market's actually shifting away from that view, saying we're actually worried about the labour market, notwithstanding wages going up. We're worried about weakness in the labour market, which we saw in the last print. So we don't think the RBA is going to go. So there's more people in that camp of we are done and we're going to stay where we are.
And the economic data in the US, I mean, that's been pretty strong. We get non-farm payrolls as well.
Yeah.
Do you reckon that the Fed's just on hold?
Yeah, I think they are. I think the market's again walking back from lots and lots of rate hikes. And I think the issue there is that rates are already pretty high, right? So they're you know, materially higher than when they are in Australia. I think one of the issues there is that wages are not going up. In fact, wages are coming down. The latest wage print was 3.6, I think, down from 3.8 from memory. I could be wrong on that, but it's definitely the direction. So I think we're seeing a shift downward in the interest rate expectations in America. I think they've still got a rate hike priced in, So I think their rate, they give a range. So they're 3.5 to 3.75. So if you like, their midpoint of that's 3.625. So the market's pricing in probably one more rate hike to 3.825 or 3.875. But it's walked back from probably more than that. So I think most clients we speak to, particularly globally, are walking back from that view that rates are going to go up everywhere. They think that central banks will look through the fuel inflation as long as it doesn't catch on more broadly. Now, you mentioned the ISM data. The prices paid index looked really ugly. So businesses, to this other point, businesses are wearing high costs, but there's not a lot of sign that they're passing them on to customers yet. So I think there's a view that they'll absorb some of it in their margin, and they'll also look to cut costs to maintain their margins as well.
You and I, we both love a chart, don't we? Okay.
Love a good chart.
Love stocks too.
Yeah.
So what's a buy right now, given all we just spoke about?
Yeah, I think there's a stock that's really in the crosshairs for us, and that's Computershare. So this is a stock that we haven't traditionally spent a lot of time talking about or thinking about, but Computershare is a share registry business, mostly US based. They make a lot of money from corporate actions, from corporate trust business, but they also have a large cash float that they look after, and they earn interest margin on that. So when interest rates went up a lot, in 2021, 2022, Computershare's earnings went up a lot as well. They make something like $700 million a year in interest income on that float. So it's a material number. So as the view is that rates are not going any lower, in fact they may drift higher, you want to own stocks that are positively correlated to higher rates. So QBE Insurance is one, but Computershare is another. This is looking at the relative PE of Computershare to the market. So it's PE divided by the market PE. When interest rates are rising, you can see that PE relative expands. So it does trade up to 50 to 60% premium to the market because it's getting those earnings upgrades. So it's started to move. You can just see on the right there, its relative PE has started to tick up. It's probably outperformed by about 10%. But we think there's that. But as you mentioned earlier, Anthropic have just filed to go public. That's going to be $1 trillion IPO. You've got OpenAI is probably also $1 trillion, and SpaceX might be up to $2 trillion. So you've got $4 trillion US dollars of IPOs coming up in the next 6 months. If you're a share registry business, that's a lot of activity for you. That's a lot of investor activity. It's a lot of buying and selling, and it's a lot of revenue for Computershare. So I think it's positively leveraged to rates. So if the market's wrong and rates are going high, you want to be there. But also, it's not trading at a PE premium. It's trading in line with the market. And we think all of that corporate activity, it's not just going to be in the States. We've got Firmus coming in Australia. That's going to be a big deal as well in the second half. So I think there's going to be a lot more corporate actions, as they call them, and that's very good for Computershare.
Can I just ask, what is your take on these big US IPOs, OpenAI, Anthropic, SpaceX, and what they might do to broader market liquidity? Because presumably to buy into SpaceX, you may very well need to sell out of something else. And I was speaking with a guest earlier today who was saying when you see these really massive IPOs, it's usually indicative of a lot of enthusiasm in the market, which we know we're seeing toward AI, and they often precede some sort of a crash.
Yeah, there's always, you got to wait for the fund managers to IPO. That's really the top of the market if a fund manager or a broker.
Yeah.
I think people like Bell Potter, I think they floated their business in 2007 or something like that. So I think if you see fund managers going public, that's usually a pretty good sign. But these businesses have been private for a long time. I think SpaceX has been private for over 20 years, and it's been hoovering up capital all along the way. It's not made a profit, so its $2 trillion valuation is mostly money that hedge fund managers and venture capital, private equity managers have been putting in along the way. So these are not, I think Google was private for 6 years or 7 years, so it didn't spend a lot of time raising money, whereas SpaceX is more like 20. So these are very well developed businesses already that are very well owned. So it's not like it's raising a lot of money. They're going to come onto the market. They're going to be a big part of the index. They've been negotiating with both Standard & Poor's and Russell to go in early, because normally you have to wait a couple of years. They're going to go in these indices straight away. There's going to be lots of demand. There's not a lot of money being raised. This is more companies that have invested at private equity venture capital stage, realising some of their investment. So there will be some sell downs from those companies going from private to public, but there won't be a lot of new stock raised. I think SpaceX is less than 100 billion raised, but it's going to have a big market cap. So it's going to be interesting to see. The index funds are all going to have to buy it, and who's going to sell it. So I think it's going to be pretty lucrative for the private equity funds. A lot of private equity funds have been in these things for, as I said, for up to 20 years. They've been waiting for this realisation moment. So it's going to happen. It's going to be great for markets. I think it's going to be good for animal spirits. It's great to be able to invest in these businesses because they're where all the action is. So I think it's a pretty exciting time to be in the markets.
Martin Crabb, CIO, Shawn Partners. Glad I asked. Thanks for coming in. Okay, so there you go. You've also got a stock pick from Martin, Computer Share. And the stock of the day today was Drone Shield. We had some commentary coming from our expert guests, Luke Winchester from Merriweather Capital and Richard Hemming from Under the Radar Report. Let's listen in.
Let's take a step back. We know all of the issues that's gone on with it. We know the management turnover and the issues around what happened there. But there is a real fundamental business here. I mean, just having a look for the program this morning, Andrew, they did $217 million of revenue last year. Turned that into about $30 million of operating profit, which, by any metric is a really good result. The problem obviously is the thematic of defence and drones doing a lot of heavy lifting in that valuation.
For me, it just shows that you can have the worst corporate governance in the world, but if you've got something people want, they'll buy it. And it's quite interesting, that chart, isn't it? Because it's right smack bang in the middle of a trading range, albeit for 1 year. But it's definitely it's cashed up, like 4DM Medical, which we'll talk a bit about later. But it's cashed up. There is high demand for its product, and their genius was actually build it and they'll come. So they had the inventory ready. But I would say, for me, it's a trader's stock.
Let's get across the market leaders today. And SRG Global, we mentioned why, Northern Star as well. There's Martin's Life 360, really benefiting from some of this change in sentiment. Pro Medicus still off the back of contract wins, looked at pretty favorably by most brokers. And Xero, there you go, buying up what some would call a bargain. Okay, let's get across those that did lag the market. TPG Telecom, Paladin, Domino's, 4D Medical had a great day yesterday though, and Deep Yellow in the uranium space. Small end of the market, some good performances coming through from Unico Silver. Don't see that one on the list often, up to 74 cents per share. And on the flip side, we did see some pretty big selling in Archer Materials. Second day in a row, down by about 11%. Tonight in Europe, we get the inflation flash estimate, and we're in that week, pre-US non-farm payrolls, where we get the JOLTS job openings read for the month of April, expected to edge down slightly to just shy of 7 million. I was going to say jobless claims, but that's Thursday. It's only Tuesday. So on Wednesday, tomorrow here locally, first quarter GDP comes in. Growth expected to slow at 0.5%. A couple AGMs being held, and investor briefings coming from Superloop and TLC. So final check-in on the market. I will note that U.S. futures are mildly negative, nothing too dramatic, but worthwhile noting. We've got Lebanon announcing a partial ceasefire between Israel and but Hezbollah attacks are continuing, so still an eye trained on the Middle East through the overnight period. We'll see if we get any further commentary coming from those peace talks between Iran and the United States. Safe to say, though, our local market has closed relatively flat, 8,724 for the S&P ASX 200. And just taking a look around the region, the KOSPI gave back some of yesterday's stellar gains, but elsewhere, positive for Chinese markets, including Chinese mainland Hong Kong, up by 2%. If you've missed any of our lovely coverage, wonderful, informative coverage today, really encourage you to check it out online overnight, and we look forward to seeing you tomorrow.